Russia, India, and China are targeting both gold and paper silver for conversion into physical. This fresh retail demand has not yet translated to the retail market, but it will, further tightening up the fifth consecutive 200 million ounce per annum supply shortfall, providing yet another catalyst to easily drive spot silver through all-time highs. Beijing no longer needs to be stealthy buyers. And with the CME LBMA open interest migrating out of Beijing's unallocated playpen, so they don't need to play this game, they have enough silver, the race to accumulate silver, along with all critical mineral assets, is underway, catching the US severely on the back foot.
Global power dynamics are undergoing a transformation not seen in generations. At the center of this struggle are the world's most important resources, gold and silver. For decades, Western institutions, led by the US and its allies through the LBMA and COMEX, dictated pricing, liquidity, and settlement in these markets. But today, that framework is cracking as China, Russia, and India strategically build positions in physical precious metals while the US finds itself scrambling to catch up. China, in particular, has played the long game. For years, Beijing accumulated gold and silver quietly, allowing Western paper markets to suppress prices while siphoning physical metal eastward. The Shanghai Gold Exchange, largely ignored in Western coverage until recently, has now established itself as the premier hub for physical settlement. It was never simply about reserves, it was about control. And control is precisely what Beijing now has, after consolidating physical inventories in its vaults through a blend of arbitrage, policy, and stealth accumulation. This is not just about financial hedging, it is about geopolitical leverage. By underpinning their monetary and strategic policies with real, tangible assets, BRICS nations are positioning themselves to challenge US dominance in trade, currency, and energy. Silver, often overshadowed by gold, is emerging as the true battleground, indispensable for defense technology, AI, and green energy, while at the same time severely undersupplied on a global scale. For years, Western markets dismissed it as a secondary commodity. The US, which long relied on paper market influence to suppress volatility, is now on the back foot. With virtually no strategic silver reserves, Washington's recent recognition of silver as a critical mineral reveals just how urgent the situation has become. Against the backdrop of trade wars, tariffs, and sanctions, the race to secure physical supply is intensifying. What this means for investors is clear. The decade-long underpricing of precious metals is approaching an inevitable reckoning. Stay tuned, because Andrew Maguire reveals exactly how these tectonic shifts are reshaping the future of gold and silver. Before we dive into his breakdown, make sure to like this video, subscribe for more market analysis, and share your thoughts in the comments. Your feedback drives this channel forward. We appreciate the support and hope you enjoy the video.
We're looking back, it's like, I can't believe it, actually ending the third quarter. It's been a lot of fun, though, pulling apart over the time. You remember we've had multiple official attempts to try and talk gold down, tamp it down. And most recently, I mean, this is so recently, Citi, even less than 2 months ago, I think it was 7 weeks ago, whatever it was, tried to gaslight the idea to sell gold because it was going to go down hundreds of dollars to as low as $2,600. Do you remember we kind of laughed at the whole concept of it because we knew they were on the other side. And yeah, this is the same bank that, along with JP Morgan, that we captured and published at that exact same time, simultaneously stealthily closing the Fed's 5-year OCC derivative bets. Remember those OCC bets, the officer controller bets? They're only published quarterly. So these guys get to have a bit of fun and do what they want to do in the dark until it's published. But we clocked it. And this really actually all boils down to the fact that the only central bank still short gold is readying to revalue US Treasury gold reserves. I know there's a lot of skepticism about it. It's happening. And as we've been drawing attention to, and we will look at it again shortly, The clues are all there. And our assessment that the LBMA COMEX is no longer fit for purpose is now gathering mainstream attention. And with that in mind, let's look at the current August CME LBMA footprints, which after the Trump tariff tantrum further reveal how a dwindling COMEX open interest, i.e. the chips, no one wants to really trade the chips anymore. It's forcing discipline on the Fed, the only remaining central bank trying to cap the price of gold and versus the dollar. And they need the COMEX to do that. And it is just, there's not enough actors. And even setting aside the Western paper-derived price mismatches versus the Asian-facing physical pricing, it was the Trump tariff tantrum that really exposed the massive structural mismatch between the Western gold market infrastructure and particularly the inefficiency of re-refining London 400-ounce bars into 1 kilo bars that Asia demands.
Liquidity providers affirm that the remaining COMEX open interest, that's the chips in the casino basically, are insufficient to command enough position concentration to actually meaningfully enable the COMEX-centric paper gold price management to continue. Now, the Fed's price suppression attempts have become so obvious that anticipated intraday, intra-month COMEX-centric official bid-pulling attempts are capitalized on by the competing global central bank, sovereign, and institutional buyers. Now, these arbitrable physical offtakes are making it increasingly difficult for the Fed to short cover leased bullion borrowings without digging a deeper hole. Into the end of the month, the Bank of International Settlements squaring, the OCC bets, were once again forced to be squared at an all-time higher priced stairstep. And with physical market liquidity now setting the global gold price, the Fed will have to fold its short derivative hand and as quickly as possible get on board the upcoming gold revaluation process. Feedback from every single physical liquidity provider's telegraph that the Fed is anticipated to follow the BIS to also become Basel III NSFR compliant. Now remember, where the BIS short covered and what happened. And now the Fed is at the position where it's got to short cover. And it's going to have to follow what the BIS did. And then figuring that most likely that the December contract, this is spot here, but this contract, which just launched, which was the December contract, and this reflects that COMEX liquidity, is very likely going to have to move in. It'll move into first notice on the 27th of November, and delivery commences on the 28th of November. So this contract doesn't expire until November. So that'll be right around this point here. Well, we suspect that the price is going to be much more reflective of our spot 4,500. Cutting through the last 3 weeks of the thinnest European, this was the European holiday here, that liquidity was extremely thin. This tariff tantrum right here was the point that actually exposed the need to quickly address the LBMA CME cartel's paper to physical disconnect. And liquidity providers report the largest exit of LBMA CME hedging flows ditching these high counterparty risk unallocated contracts for fully allocated physical gold. And that's what we're seeing.
Now, the drain of leveraged unallocated LBMA gold into fully paid up physical gold vaults outside the cartel's ring fence will ultimately force the Fed-run cartel to embrace full Basel III compliance or become irrelevant as a gold trading hub. And what we mean by Basel III compliance, they will have to have the physical that backs up these positions. Drilling down, the footprints are revealed one by one. And as we assessed in our last episode, following the largest, technically non-delivery month, just a futures month that really wasn't designed to be a delivery month, the August gold loadout, it was the largest in history. And we expected that any remaining undelivered paper warrants would be forced into delivery by first notice on the 28th of August, which was the last day to contractually deliver or fold your position. And as we've often remarked, in physically settled markets, gold being called for delivery is settled at worst T+1, and in many of the futures markets, physical markets, T+0, but T+1, meaning 1 day to physically deliver a fully paid up bullion bar. So that should be the worst case scenario, because that is Basel III compliance. Now, a quick delivery enables the seller of those bars to exit their storage costs, hedging costs, insurance costs, all that kind of stuff. So when they drag delivery out into a T+30 day delivery protocol, clearly it telegraphs the COMEX gold was never real in the first place. It was just a paper shuffle of warrants. And by delaying delivery, the object was to try and square these paper warrants at a cheaper price.
Andrew's remarks cut straight to the structural weaknesses of the Western gold market. For years, official attempts to talk down gold prices relied on derivatives, leverage, and opaque reporting practices. Yet, as he highlights, the cracks are now visible to anyone paying attention. Open interest in COMEX is evaporating, and liquidity providers are increasingly unwilling to back unallocated contracts. The result is a market that once dictated global prices, now struggling to maintain relevance. At the same time, silver's position is becoming more pronounced. If gold has served as the flagship for monetary revaluation, silver is emerging as the critical secondary asset, one with unique industrial and military applications. Supply deficits stretching back 5 consecutive years have already pressured inventories, and now, with BRICS nations stocking up, the stage is set for significant dislocations. Before we get into Andrew's analysis of silver's breakout, it's important to understand that the US faces a uniquely precarious position: no meaningful reserves, a reliance on imports, and the pressure of having to backfill strategic shortages at rising prices. Let's get back to Andrew Maguire's video.
Can you update us on what you're seeing right now? It's been a big week for silver and what you're expecting moving forward with silver.
Yep, it's the breakout we were waiting for. Let's look at the fundamental reason, though, driving this 14-year technical upside silver breakout. And while lagging gold, foreign exchange silver came into the SGE crosshairs directly after the Bank of International Settlements forced FX spot gold to become deliverable. Now, following gold having been revalued as a first-tier high-quality liquid asset on the 1st of January 2023, China, Russia, and BRICS nations began stocking up physical silver for military, AI, and green energy applications, military being a big component of that. However, now that the US has recategorized silver as a critical mineral, what it's done is ignited a race by the US to also stockpile silver, severely limiting the sales of US silver, in turn incentivizing global sellers to hold out for yet undetermined but significantly higher physically determined prices.
Shane, here's the monthly target you referred to that we circled in our last episode, which was right here, and the price was way back here. And the end of the month, this is a monthly bar, the end of the month exactly fulfilled the August target. Now, while we expect $52, 53 in fact, or very close to 53, to be secured as the next highest stair step to rally from, along the way, the next immediate target is 44,275. Now, this is a futures chart where we expect a fight here, but very large commercial short stops sit above this pivot. This is where a huge amount of shorts were added, and not all of them have been covered on anywhere close to getting covered on this rally. So you're going to see some resistance and you can see a fight, but once it's through, then really it's blue sky. And guess what? Beijing knows exactly where these stops are, here and here. Following Trump's unhelpful confrontational comments today, this is the Wednesday the 3rd, Russia, India and China are targeting both gold and paper silver for conversion into physical. This fresh retail demand has not yet translated to the retail market, but it will, further tightening up the 5th consecutive 200 million ounce per annum supply shortfall, providing yet another catalyst to easily drive spot silver through all-time highs.
With the US now competing to secure tight for supply physical silver, it's going to unsettle the SGE's stealthy 5-year privileged physical concentration position. Now the gloves have come off, and over the last 5 years, the SGE has successfully utilized control of its global position concentration, employing SGE physical to unallocated spot hedging mechanisms, which were structured to enable them to arbitrage the difference while at the same time containing the silver price, as it strategically was flowed into Beijing vaults. Guess where it was coming from? Or out of the West. So geopolitics, trade wars, and a direct frontal attack on competing BRICS nations declared Beijing no longer needs to be stealthy buyers. And with the CME LBMA open interest migrating out of Beijing's unallocated playpen, so they don't need to play this game, they have enough silver, the race to accumulate silver, along with all critical mineral assets, is underway, catching the US severely on the back foot. The US has come out of the gate with almost no silver reserves, which will mean they will heavily sanction or ban US silver exports, almost certainly. However, the Fed has accrued a very large naked short, unallocated Office of the Comptroller listed FX silver position. It's the only place it shows up, which will now come into Russia and Beijing's crosshairs because they know about it too. So they know that that has to be short covered because there is no silver to back those positions up. And technically, FX silver should be deliverable. Now, the White House mandate to buy silver will drive an inflection point, forcing the Fed to buy back these unallocated bets into higher and higher prices. So drilling down, note the massive end of session margin call, where we had a $1.07 EFP basis spread required to short cover the asymmetric imbalanced COMEX-centric December futures, so-called hedges, versus the spot long legs being locked in and called for delivery. Now, footprints indicate this was commercial short covering, which drove spot silver into these 14-year September 2011 highs. Worse, into yesterday's silver short squeeze, into the margin calls, captured here, the EFP basis trade short squeeze had expanded to as high as $1.24 at the open. And given all the major bullion banks are long silver for their own book, there was little doubt these short capitulations were Fed-related OCC bets being bought back. This jives with evidence that the 5-year Fed-held OCC derivative bets against both spot gold and silver had been short covered during the first quarter of 2025. So as expected, December silver futures deliveries have commenced in very large size following first notice. There was 7,702 lots, which was 1,198 tons. They were delivered with another 584 lots yesterday. And there's still about 400 tons left to deliver. So really, in summary, into dwindling overall COMEX open interest, the CME LBMA market makers in both gold and silver are increasingly becoming price takers. To those looking at analyzing the house-generated COT reports, which I know a lot of traders do, the fact that these reports fail to indicate the degree of COMEX to FX spot imbalances, i.e., that which lots are hedged or not hedged, what gold is doing is flagging a risk about US debt that other assets simply are not. And with that in mind, there's never been a better time to opt out of the debt-riddled fiat system by simply swapping your debasing dollars, euros, pounds, yen, whatever, for physical gold and silver.
Andrew's breakdown underscores a reality that Western policymakers can no longer ignore. The pricing power for gold and silver has shifted east. The Shanghai Gold Exchange and BRICS accumulation strategies are not temporary responses to U.S. monetary policy. They are part of a long-term structural realignment. By forcing delivery, rejecting unallocated contracts, and demanding physical settlement, these nations are dictating the new rules of engagement. For investors, this means that the days of trusting paper price signals are over. The implications for silver are even more dramatic. With deficits running at 200 million ounces per year and industrial demand accelerating, the physical market is already stretched to breaking point. The U.S. mandate to classify silver as a critical mineral is an acknowledgement that its importance extends far beyond monetary value. It is vital for national security, technological leadership, and the energy transition. Yet Washington's lack of reserves leaves it in a reactive position, forced to buy at ever higher prices. Gold, meanwhile, is poised for a revaluation that could redefine sovereign balance sheets. As Andrew emphasized, the Fed's short positions are unsustainable, and like the Bank of International Settlements before it, the U.S. will eventually be forced into Basel III compliance. When that happens, the adjustment will not be gradual. History shows that monetary resets often occur suddenly, with little warning, leaving unprepared investors exposed. Taken together, these dynamics represent a perfect storm: geopolitical confrontation, structural market deficits, and a loss of Western control over pricing. For well-informed investors, this is not a time for hesitation. Positioning in physical gold and silver now, before the full impact of these shifts is priced in, may prove to be one of the most significant investment decisions of the decade. If you found this analysis valuable, don't forget to hit the like button, subscribe, and share this video with others who need to understand the changing global monetary landscape. Let's continue this discussion in the comments. Do you believe silver's breakout is just beginning? And how do you see the US responding to this geopolitical metals war? Thanks for watching, and see you in the next one.